Things started mostly accumulating back in 2008 when there was this greatest financial crisis, global financial crisis, and you see that somewhere from 2008 gold started rising, its spectacular rise from $800, almost $1,000 by $2,000 by 2011. So it more than doubled over the course of 3 years. It more than doubled. Then there was this flat development, like we call. Last time we said that actually markets develop, do develop. Mostly they increase or decrease, or they remain stable, flat. The majority of all movements in the markets are flat. So this movement was a flat movement. Of course, there were months when gold went up and down, so traders used this volatility to gain something. But the real thing was when gold price started going down. And this is where it is very interesting. So why it went down? So why after so many years, after 3 years of the global financial crisis, what happened so dramatic that led to such a spectacular decrease again, down to 1100? So it almost reached the level before the global financial crisis, yeah? So it's almost touched again that level of 2008. What was the reason behind that great slump? In 2013, Donald Trump was not the president of the United States. So this cannot be a driving factor, a driver of such a slump in gold prices. So that was still Barack Obama. And during Barack Obama's time, the president of the Federal Reserve System, the governor of the Federal Reserve System, Ben Bernanke, was still in power. He was one of the most powerful people in finance, in global central banking activities, and he actually went through the global financial crisis. He sustained his reign during the global financial crisis. There were people he wanted a replacement for him, but he still remained in power. And actually, he was one of the people, this Ben Bernanke, who told just before the financial crisis in 2006, he was not yet the Fed governor. He was working at the Fed. He was one of the people behind the economic policy and statistical analysis at the Central Bank of the United States. So he was dealing mostly with analyzing statistics, analyzing the markets and what to do, what if something bad happens. He was responsible for many things. Actually, he's a good scientist, and he gives lectures sometimes at leading universities in the United States. Even he did that, for example, in 2012. He gave a course of 4 lectures, a series of 4 lectures at the George Washington University. And he was talking about the central banking policy over the centuries, over the past 100 years, mostly when central banking started its spectacular and dramatic increase in rise in power. So in 2006, when journalists asked him about housing prices, because there were speculations that housing prices are going to collapse. Why are people so interested about housing prices? back in 2006, actually back to the early 2000s, there was a spectacular increase in housing prices all across the world. Mostly, of course, in the rich world, in the European Union, in the United States. What drove those housing prices in Europe, was the immigration. Because in the early 2000s, there were many new members to the EU, like Poland, Bulgaria, and other countries in the Eastern Europe of the former Soviet bloc. After the collapse of the Soviet Union, you know, the Soviet bloc collapsed too, and now these countries, by the early 2000s, became the members of the European Union, and they started to immigrate to the better countries of the European Union, more stable, economically developed, to Germany, France, Great Britain, Belgium, well, to other stable economies where they made way lot more money than they usually did in their poor East European countries. So they did that, and that drove housing prices in Europe, in Western Europe, because it is quite understandable. The more demand there is in the housing market, the higher the prices are. And so people all across Europe started suffering this huge spike in prices. Homeowners in Western Europe, some homeowners, were happy about that, because they could sell their homes and get profited, then buy again and sell it at higher prices. Yeah, so it was like a casino. People invented a new kind of casino. They had real property, real estate, and they bought and sold it just like they wanted it. And as soon as prices went down, they bought property. As soon as it reached a certain height, they sold their property, bought another one after some time, or they took money in credit. They got loans. In the United States, people got loans because interest rates were not really high and people were happy to get very good mortgages. Mortgage is a loan to buy a property, a house. In the United States or in Great Britain, it's the same thing, mortgage. And people were really obsessed with that idea that they could get rich very quickly. Well, quickly, that means maybe a year. In a year's time, when prices doubled, they just sold their property, took another loan, bought another home, waited for a year, sold it again, repaid their loans to banks, and well, people were quite happy about that. Some people, at least. Immigrants were not happy because they could not buy better homes. They had to live in worse conditions than other people in Europe. But still, the speculation was really spectacular back then in the early 2000s. Housing prices were driving higher and higher. And Ben Bernanke was asked, some of the journalists asked him in 2006, will there be any collapse in housing prices? And the first thing that came to his mind, he just said that we at the Fed, at the Federal Reserve System, do not know any experience from the past of slumping housing prices. So he was sure that housing prices would not go down, would not plunge. And that was in 2006. Actually, keep in mind that when politicians and policymakers give some certain promises, very strong promises, when things really heat, when there is a heating situation in the market, when prices are boiling and the market is boiling, and they are asked about the future development, do not trust them, because usually when they say that this situation will continue and everything stays okay, is the first sign that something is really not good, and that we are at a sort of a brink of a very great event that could come. And this event came in 2007. It came very suddenly as a subprime mortgage crisis. Subprime mortgages. What is subprime mortgage? This is a mortgage given to people with less conditions asked, less documents asked. For example, when you imagine a group of people or all people in the housing market, and they would like to have some property, and they need a loan, for instance. And in countries with strict regulations, banks are very, very restrictive and very reluctant to give money to people with questionable incomes or low incomes. And in the United States, George W. Bush, the president back then, George W. Bush, he announced a new policy. Own your own home, it was called. And this policy drove the US banks to give more loans to the public. They decreased at the Fed the interest rates, and mortgage became very, very cheap. And people started buying more property for loans. So they had no money, these people. You see, they had absolutely no money in their pockets. They were so poor, or their incomes were unstable, that they could not afford a home in usual conditions before this policy started. But now, after a slump in interest rates, actually by the time the Fed governor was Alan Greenspan, today he is usually accused of precipitating the global financial crisis because he kept interest rates really low, all the way to the global financial crisis that happened in 2007 and 8. Alan Greenspan was at the helm of the Fed for 17 years. He was one of the longest serving Fed governor in history of the United States. His policy was an easy money policy, cheap money policy. And so he was one of the people behind this subprime mortgage crisis also. He can be called responsible for that too. But also we may say that his period was quite a period of stable economic growth, stable inflation, stable unemployment, and stable financial markets. And as soon as he left his office, things really started growing very, very difficult. The clouds started to darken, and the world went on the brink of collapse, so to speak. So Ben Bernanke said that there will be no decrease in housing prices, but like I told you, there were many people willing to buy homes for cheap loans, and they kept doing this for many years, for at least 7 years before the global financial crisis. And like I told you, they had absolutely no income, basic or good income to buy that property, to afford that property. Banks were very eager to give them those loans, and they were doing it on a very large scale. For example, they give loans as high as $500,000 or $1 million to buy a very good villa for people who usually lived in sort of slums, almost with no roof above their heads, so to speak. In the United States, there were many poor people, actually, millions of them. But now these millions afforded new housing, and this housing can be called villas, really. If you just look at photos and pictures in the internet of these villas, they are very, very spectacular. Like rich people living in paradise. That was really the situation of oases in the desert in the United States, when people really started owning their own homes, like George W. Bush promised them. And he kept his promise. He kept his all the way to the global financial crisis in 2007. And when people got their homes, they could take another loan. Just imagine that. So they were given a loan to buy a property, a villa. Then, as time goes by, for example, a year, their house rose in its value. Yeah, it doubled, for example. They purchased it at $1 million. Now it costs $2 million. That means they can take another loan for yet another $1 million US. For example, to construct a garage for their car. Also a sort of a property or real estate. You buy a garage, you construct it, you build it, everything goes okay. Then 1 year passes again, and you again take a loan, and you pay for the education of your children at Harvard University or another very good university in the United States. So after that, banks offered another good thing. You could actually accumulate all this debt on one account. All these debts, student credit, student loans, mortgage, garage loan, a car loan, everything, you bundle it together, put it in one bank, and create one account. Then, but you've got no actually money to pay back those loans. Yeah, you still owe banks interest and the principal, actually, because you could actually repay your debts if you sold everything. Yeah, if you sold your car, if you sold your villa, if you sold your garage, but you would not. You do not want to do this because the life is really the happiest of lives. Yeah, that was the millennium. This millennium started with a sort of a dream that people, a new American dream that people could own their own homes and live in paradise and pay absolutely nothing for this. So, in a capitalistic country, this is really difficult to imagine, because this is a sort of a socialism, yeah? Sort of a socialism when you're given affordable housing and everything is good, everything is okay. So, there were really many subprime mortgages. They were called subprime. So there were mortgages, real mortgages are called just mortgage. This is a loan you have with a bank, and you are obliged to pay interest and repay the principal after some maybe 30 years. Because usually in the United States, a villa costs really much, and it takes almost 3 decades for you to repay that loan. So this is a mortgage, and this is a very important thing in any economy and in any society. But then come these subprimes. Subprimes means that they are of a worse quality mortgages. So that means there is actually no insurance and no guarantee that someone will repay those loans if something happens to you. And what can happen to you? You may lose your job, you may lose your property, something actually may happen, or there may be, due to global climate change, global warming, and floods, your property will be smashed from the face of the earth. So, and you will lose everything but your lives. So, in the end, you will have to pay your debts, or go to prison, actually, or to serve those debts. And these mortgages were called, like I told you, subprimes of a worse quality mortgages. But there were really many of these mortgages. And like I told you, banks started offering you to bundle those mortgages in one package, everything on one account, so that these loans could be sold to other people, other banks or financial corporations through derivatives. So they just wrote paper for these subprime mortgages, and these papers were called CDOs, collateral debt obligations. Now, this is a very interesting paper. This paper actually is a sort of a security that secures somehow, so-called secures, it secures your mortgage, that if something happens to you, someone will repay, and that someone is a company or a financial corporation that bought those CDOs in the first place. Now, which CDOs would you like to buy? If you're, for example, a Lehman Brothers bank, the bank of a sort of a Lehman Brothers, this 150 years old bank, what kind of CDOs would you like to buy? Of course, the surest, the securest, the most secure CDOs. And that means they got to be triple rated. What does it mean, AAA rated? AAA rated. There is a bunch of credit rating agencies there in the United States. The Moody's, the Standard & Poor's, and Fitch. These three credit rating agencies, they rate everything. They rate securities, bonds, government bonds, corporate bonds, shares, etc. Bank bonds, bank shares, and they rate it, for example, triple C, triple B, triple B plus, BB plus. The highest of all ratings is AAA. What does it mean, AAA rating? That means that this security, which is AAA rated, is the most secure in the world. And if you buy it, nothing will happen, and after some time you will get profited. Doesn't it sound really fantastic for you to own? Yeah, but behind these CDOs, triple rated CDOs, AAA rated CDOs, are these subprime mortgages. Of course, when it is only one subprime mortgage of Mr. Smith and Mrs. Smith, nobody will buy it. Yeah, because, well, anything may happen to you, and Who will repay me those loans? If I give you money to buy a garage or a house, a car, or get your people educated at Harvard, etc. It amounts to millions of dollars for a single household. And $2 million 20 years ago is not the same $2 million today. Yeah, you must understand that. $2 million back then, 20 years ago, it was way more valuable than it is today. Because money loses value all the time. Inflation, and things such as these. Gold prices. So the interesting thing is that these banks and these organizations, subprime mortgage organizations, started to bundle loans of these smaller homeowners in one package. They just took one CDO plus another CDO of another household plus. So they added it together, summed it up, and after some time they took this bunch of CDOs and subprime mortgages, packaged it in one CDO contract, and rated it at Standard & Poor's or Fitch or Moody's, and it was AAA rated, and that was a very secure thing. So this business was absolutely fantastic because many people got profited just because these CDOs were traded, purchased and repurchased, sold and resold again, and each time they were resold, someone got profited very much. Banks in Germany. Germany is a country with the most conservative banks. Because this country actually survived World War I, World War II. They survived hyperinflation in 1920s with these billions of percent inflation and foreign exchange rates. So they survived with 10 million unemployed people, and their banks are considered to be the most conservative banks. And what does it mean, conservative? If they take deposits, they keep it, and they are very responsible for not giving these deposits to someone else for uncertain purposes. For example, subprime mortgages. Nobody in Germany will do that. But now, not now, when they've seen those CDOs and how much profit other banks in the United States, for example, got from those mortgages, they started doing the same thing. And really small banks in Germany, conservative banks, started purchasing those CDOs in bulk, in great packages. So they used deposits of average Germans to buy those CDOs. Millions of euros went to buy those CDOs, those empty papers. One economist in Germany called them, he said, we call securities value papers because they value something. But actually these CDOs were unpapers, so to speak, without any value behind them. So many banks in the world did the same thing. They used deposits, real money, real cash, to buy CDOs. And now, the stock markets, the financial markets in 2006 I think that was the height in the global temperature, so to speak, the height of the temperature in the financial markets. Oil prices were, oil cost, Brent crude oil, $150 a barrel. Today it's 70, 78. Yeah, it was twice as much in 2007. Twice as much as it is today. Many other assets were also very expensive. And there comes it came about as a surprise. Nobody expected that it can actually happen. And it came as this, again, like I told you, subprime mortgage crisis. Just one bank, there were speculations that Lehman Brothers cannot repay its debts. All these securities and all these CDOs accumulated, and they had to get their loans back, but they couldn't. And there was a huge hole, so to speak, a huge hole that was established in the balance sheet of this 150 years bank. Everything it had was actually good reputation only. But you cannot pay with good reputation money back to someone else, because this bank owed money to other banks, because it took loans from them also to buy those CDOs. And this bank collapsed, like we know. And other banks would have collapsed as well, because each and every bank in the world owed something to one another. That was a whole chain. It was called the contamination effect. Each bank contaminated another, so to speak, like a zombie, yeah, in a computer game. If you touch a zombie, you die, or you become a zombie too, yeah? You become yourself a zombie, so to speak, and continue living, but in another world, and consume people, drink their blood, etc. And do other nasty, really nasty things. So they did that, and Lehman Brothers, the Federal Reserve System was considering to sell this bank to some good corporation. Well, because usually banks keep some long-term assets. For example, buildings, yeah, they got buildings, they got some equipment, subsidiaries, they have good securities also, good bonds that could give them money in a couple of years' time. They got treasuries, the US treasuries. So if you have these long-term assets, the Federal Reserve System can take them from you, these good assets, and give you cash to just repay your customers' interest on their deposits, for instance. But this time, there was a different situation. They actually used all those long-term assets to buy the same things, CDOs. So there were above years in these CDOs, in an ocean of CDOs, of just simple paper, with nothing but loans of other people and debt of other people, to third parties, etc. So that was absolutely a nightmare. There was this craziness in banks that you could get profit from these simple paper. And there was an idea that this paper is as sure as gold. So can you imagine that? Now we cannot imagine that, of course, but back then it was possible. It's like in a fairy tale story. In Russia, you could imagine that when Ivan the Fool was always lying on a sort of an oven, and he kept himself warm there and did nothing for 30 years. But in the end, he marries a princess and actually is a very rich guy with nothing behind him. So now in the United States, in a capitalist country, and in Europe, people experienced a sort of a Russian fairy tale story. Like Tsarina Catherine the Great, who actually was a very poor princess in Germany, a very poor princess, because he had to stitch her stockings all the time, because they had no money to buy stockings in their family. So that was a very poor family. And later she became the empress, and the story was like the story of Cinderella. And now these Cinderellas were multiple, in millions of hundreds of millions of people were Cinderellas, and they wanted to become ones, and they actually became. But it is always when the clock strikes 12, things change, and now this clock really struck, and this bank collapsed, and it took with it all other assets of other banks. The United States, of course, Ben Bernanke, he became the chairman of the Fed. He understood that if we do not do something at this particular moment, things will accumulate and the whole financial system will collapse, because one bank will contaminate another bank, and that other bank will contaminate another bank, and there will be no end in this whole chain reaction. There will be an explosion in the global financial system, and it will collapse. It will be like a house of cards that will collapse just in a matter of seconds. So just like Cinderella, Cinderella story, that ended in this way. Of course, there is always a happy end story also. And in the United States, this happy end, so they started printing more money actually at the Fed. They just issued, first of all, Barack Obama signed and the Congress approved this new monetary policy. They started issuing more money, purchasing more bonds. They purchased almost the whole financial system in the United States. For example, the US government owned 60% of shares at AIG. AIG is one of the largest insurance companies in the world. American International Group, it is called. It stands for American International Group, AIG. The Fed and the government of the administration of the United States bought $180 billion worth of assets, of toxic assets, of this bank in order to keep it afloat. And that amounted to 60% of its equity. And now it was 60% government-owned enterprise, AIG. Before that it was a private corporation, but now, back then. Now, of course, it again is a private corporation because they repaid those debts back to the Federal Reserve System and government, and now everything is okay. The happy end, so to speak, really is a happy end. Like in every US story, in every Hollywood film, there is a happy end. But back then, in 2008, there were lots of these financial institutions with holes in their balance sheets with no money at all. And the government put in almost $1 trillion into those institutions, and things really stabilized. Their interest rates were low, like I told you. Yeah, they kept interest rates just like today, almost down to zero. And that's why we see this huge increase in gold price, yeah, like I showed you. That was because interest rates were very, very low, and the dollar was a sort of a weak currency, so to speak, today, back then. And people, the stock market, the traders bought more gold. That's why it drove in price. But in 2013, they thought, at the Fed, they thought that now time came to increase interest rates because the economy really recovered, they believed. And we got to stop this perpetuation of money creation, because you cannot create money all the time. Inflation is a real thing. It may come and eat away the value of everything. So in 2013, the Fed announced its what is now called taper tantrum. Taper tantrum. That was another word for harsh macroeconomic policy. Harsh or tight monetary policy or monetary tightening. Actually, it has many names for it, but the thing is the same. The idea behind this policy is you increase interest rates, key interest rates, central bank key rate, you increase it, and you stop purchasing bonds, you stop purchasing corporate bonds, government bonds, you stop multiply money in the system. And what did it mean? It meant that now the dollar was in value again. Why was it in value again? During these fairy tale years, when interests were barely a zero, or almost 0%, loans were cost absolutely nothing. Like I told you, people got loans to buy everything from homes to their children's education. And money was multiplying, so everyone was happy. But when interest rates are higher, you will have to repay those loans at higher interest rates, And people got to do that. Actually, I did not tell you one more thing, a very dramatic thing that happened to people in 2008, all those poor people. I just did not tell you the end of the story, What happened to all those happy people who became suddenly Cinderellas, with homes and education and garage and cars for each family member. What happened to them? When this subprime mortgage security market collapsed, banks started demanding back their loans immediately for immediate purposes. They delayed those repayments because people lived, like I told you, in the hope that house prices will get higher, and I will just get that difference and repay my debts, and everything will be okay after that. But when housing prices collapsed and your homes absolutely cost nothing, you could not even sell those homes. Why couldn't you sell those homes? Because suddenly there were too many people selling their homes as well. So supply was really, really great. There were too many homes, like they say in books. They had too many homes, chasing too few people to buy them. There were more homes to be sold than there were people to buy them. And that's why they cost now absolutely nothing. And banks started calling on their borrowers, he borrowed money from them, started calling on them, picking on them, demanding back their loans. And what did they say? They had no money to repay. If you do not have your money to repay, that means your homes will be taken by those banks as collateral. This process in English is called foreclosure. And people, for example, after working hours in some office in New York City, came back to their villas, they started seeing this advertisement on their doors. And this advertisement said, foreclosed. You could not enter your own home. This American dream of owning your own home collapsed just in a matter of minutes after Lehman Brothers collapsed, taking with it all those CDOs with it to its grave, so to speak. And this property now was in millions on balance sheet accounts of banks, of commercial banks, and they cost absolutely nothing. A villa of $1 million on the balance sheet of a simple bank costs something like $10. You could buy that for $10, and after a year's time it costs absolutely nothing. Because why? Because actually for a home to be a good home, so that it could be marketable and sold again on the market, it should be maintained. But now, if you do not maintain, if you do not make some renovation, repairment, it starts to collapse also. And it lost value, it lost it so much that in the end these homes were just smashed from the face of the earth. And now actually they had to do that in order to stabilize the market. It is always a sort of an idea that by liquidating something in the market, you will create sort of increase in prices and value. When there is something too much, you got to decrease the quantity of that too much. It's just like during the Great Depression when Franklin Delano Roosevelt declared his New Deal policy, and they were burning down oranges, they were burning down fresh vegetables, everything, in order to decrease the amount of agricultural products in the market so that they become more valuable. And now the same thing happened to homes. There were too many homes chasing too few people. And at the height of this subprime mortgage, each day in the United States, 800 families lost their homes. They had nowhere to live. Just imagine a country, the richest country in the world, with 800 people, 800 families, not people, 800 families with little children, school children, grandpas and grandmas, with no roof out above their heads. Some of the people had to live in their cars on the parking lots during those nights. But in the United States, it is actually prohibited to sleep in cars on parking lots. But still people slept there. because there were suddenly too many people, and the police could not just drive them away because they feared a general social explosion, unrest, a sort of a revolution. The situation was very serious. In the United States, there is a scoring system. Each borrower has a rating also, just like any bank and company. They have a rating. What does it mean, they have a rating? It means that my ability to take loans and my ability to repay them back is dependent on a certain number, which is given to me as a personal rating. And if my rating comes down to a certain level, a lower level, for example, a level which is not considered to be sustainable by the bank, I cannot repay my loans back, even if I am able to do that. This is a sort of a stupid, it sounds stupid. So you have your money, for example, it was just, maybe someone died, unfortunately, one of your grandpas and grandmas died, and they had a little property to scramble, and now you've got money, and you can repay your debts to this bank and keep your home. But not now, because you've got a credit rating, so to speak, and this rating is very low, and that means the bank has no legal right to get your money, because your money is of so poor quality that it cannot take it from you. Stupid. Imagine in Russia if in the end we are as developed as the United States in terms of mortgage market, in terms of financial system, and all of us with this sort of rating, that will be, I think, also kind of a nightmare. Maybe someday we will have that, just like every teacher and every student has a sort of a rating. In the financial university here, each of us has a rating. I have a rating because students rate us teachers, and students have ratings, and everyone sits actually in a sort of a cage of ratings. And by this example of these loan ratings, credit ratings, borrowers ratings in the United States, you may see that if we continue this way, if we continue this process of creating more ratings and trying to accumulate them and introduce to all spheres of our lives, we will end up in a cage, a sort of a prison, a digital prison, something of the sort. You will have these borders that you will not be able to break. In the end, people will tell you, like I told you last time, some people above in banks and central banks will tell us what to buy, how to buy it, where to buy it, what not to buy, etc. And that will be the final days of our life, the end of all life on the planet, so to speak. Besides epidemics, maybe epidemics will be a better choice to die, so that you do not struggle against those ratings. It's better die than live in this golden cage of ratings. You've got a very good rating, you're a very good teacher, but still there is a sort of a border between you and other people, and you cannot do anything which is not standard. Because there is always this standard that you must stick to. And if there is standard, that means no creativity. And no creativity means we will have to do dull things, we will have dull lectures, dull seminars, because all we're interested in is ratings. Yeah? But of course, there are people who are not quite interested in that, in those ratings, and they still try to do the thing they consider to be good and valuable in terms of education for other people. So, in 2013, they finally decided that the economy really returned back to its heels. People got their jobs again. They repaid their loans to banks. The financial system stabilized. The capital adequacy increased all across Europe and the United States, all rich countries. So everything seemed really okay. And they started increasing key rates, central bank key rates, and that, like I told you, was taper tantrum, tight monetary policy. And that was the moment, that was the impulse, like I told you last time, an impulse that drove gold price down now. What happened to the currencies of other countries, like Russia, for example? Russian ruble started its spectacular slump just as this policy was introduced in the United States. In 2013 and early 2014, Russian ruble devalued. From 33 rubles a dollar, it went up as high as 60, 70, and at the height, when international sanctions added and the Crimea annexation happened, Russian ruble went down as far as 87 rubles a dollar. And that was another story. And Russia, of course, was not the only country in the emerging world that suffered really much. All countries across the emerging world, South Africa, Brazil, Mexico, all of these countries, poor countries, faced this situation. Their currencies started going down. Why? It's the same situation like with those Cinderellas. Before 2013, when loans were cheap, the dollar credits, dollar loans were cheap. They took those loans themselves, the governments, I mean, all across the world, in Russia, in Brazil, because your loans in rubles, how much do they cost, those loans in Russia? They cost very much, yeah? To take a loan, to have a loan from a Sberbank, it will cost you more than 20% a year. In the early 2000s, it was more than 60% a year. So that means if you take 1 million ruble, you will have to repay 1.6 million rubles by the end of the year. So that was absolutely impossible for you to have a bank loan in rubles. And many companies, and what are those companies? The greatest companies of Russia, oil companies, Gazprom, Lukoil, Rosneft, they all took loans, dollar loans, abroad because they were cheap. They took those loans and, well, that was when everything was okay, yeah, before 2008, when everything collapsed. And as soon as these things collapsed, in Russia the situation was really dramatic. And all across the world also, the same people the same kind of people, the same kind of companies. They were all in the same boat with these dollar loans. They had to repay. That means the demand for dollar was so high that it drove its value, and gold just lost its shine for now. And that was all the way to 2019, yeah? 2019. And now this unfortunate event happened, actually. So gold was not very interesting asset. It fluctuated and it remained flat for many years. From 2013 to 2019, there is no absolutely, if you own the gold, a bar of gold, you could not profit by it because no volatility, real volatility. There was this volatility, but to predict that for simple people was not possible. It is only professional traders who can do who trade every day, every single day in the markets. They know this. But we people, if we invest in those silver coins and gold coins, called investment coins, we will absolutely get nothing from those investments in the end. But in March 2020, epidemics, and you see the most spectacular thing at the height of these epidemics. You will see this picture for every asset, actually. If you take any asset, whether it's a currency, a British pound, silver, oil, anything. So it went up as high as this, each and every asset. And in a matter of days, they lost, for example, gold lost $400. $400 means a very great amount of money. And then, in a matter of days, it started growing. Why? The same recipe. The same recipe. The Central Bank of the United States and the central banks all across the globe slashed interest rates down to zero. They started printing more money. They promised to buy each and every bond, even of poor quality, from companies, corporations, banking corporations, financial organizations, everyone and everything. And this immediately was an impulse for the market to grow. And each and every asset, like I told you, British pounds, Australian dollars, New Zealand dollars, Russian ruble, they started to recover. Oil prices, gas prices, natural gas prices, liquid natural gas prices, everything started to grow. And now we came as far as August 2020. That was the height of gold prices, and I think each and every asset as well. Silver, palladium, that was an absolute ceiling for those assets. Why that happened again? Why gold started its decline? The situation is quite different, isn't it, from the from 2013? The situation is quite different. So interest rates are still zero. That means money costs nothing, and the answer would be buy more gold. The money has no value absolutely today. It's paper. It's just simple paper. So what is happening? What is happening is inflation and the uncertainty about what is the next step of the US Fed and the European Central Bank. And in August 2020, they started speculating, traders, financial markets, each and every one in the markets, they started speculating about the policy of the United States, the Central Bank and European Central Bank for the next years to come. And although they did not increase rates, the situation of uncertainty and this nervousness all the time, that this abnormal situation just kept people on alert, so to speak. Each time there is an announcement at the US Central Bank, and that happens each month, they announce again zero policy rate, zero monetary policy, but despite this sort of stillness in the ocean of storms, there is always a feeling that these storms will come. And that situation plus inflation, plus this uncertainty, it keeps feeling that the dollar will soon be in value again. There will be a first step for a taper tantrum, and taper tantrum the second. Yeah? Taper tantrum the second, tight monetary policy, less bond purchases, higher interest rates, the dollar will get back. So this is the fear of many countries, and not just in the United States and Europe, but all across the world. They understand that they will have to repay those cheap loans they took during the epidemics at zero interest rates. And now their strategy is to buy more dollars for the doomsday. The doomsday, or the day of the final judgment, right? They are awaiting this day of final judgment, when things will again hit them, and they will have to repay those loans at high interest rates. So, in order not to wait for this situation, just do what? Buy more dollars now. And that's why gold prices, silver prices started their slump, and resources such as oil. Whose resources are these? Oil and gas. They are the resources of poor nations, so to speak, of the emerging markets. Russia, Brazil, South Africa, they are the resources of poor nations, so to speak, or middle-income nations, lower middle-income nations, the way you call them differs, of course, depends on some measures at the World Bank or the IMF. That means their currencies will be in value also now, because oil is going up. And Russian ruble, if you look at the Russian ruble, the way it looks today, actually after the dramatic volatility due to epidemics, a slump and then an increase, now it is blocked in a sort of a corridor due to financial policies in Russia, in the United States, and due to increase in gas prices, gasoline prices, oil prices, because Russia is the largest supplier of gas, one of the largest suppliers of oil, and it keeps this currency a bit stable. It's flat. It's flat now. This movement in the currency is flat. if you look, last time, what were we looking for mostly last time? We were looking for impulse points. What was the impulse points for that or the other asset? Yeah, for the gold, palladium. If you look at this chart, a ruble actually lost value all across its history. It lost its value, so it started somewhere from 30, then it was 50, 55, 60. So it never actually increased in value. That was only temporarily. So that means each and every impulse point will be where? Higher and higher and higher. And where was this last impulse point? It was here. The last impulse point was somewhere here. And that was June 2020. And now the Russian ruble is sort of in the power of that impulse point. And we used our instrument, which is called Fibonacci retracement. That will be our point to technically analyze the Russian ruble. Yeah, and actually many other currencies in the world, because in June 2020 there was another package in the United States. Donald Trump signed into a package $2 more trillion to issue for the US economy to help it recover from the pandemics. And many countries in the world and their currencies started to recover once again, all the way up until this particular day. So we live from, it is more than a year, now, June 2020, now it's September, the end of September 2021. This is more than a year. We live in a sort of normality. But this normality is a normality in a stormy ocean. It's like a small island, and you very small people, a very small nation, you live on that island, and each day you're expecting these tsunami coming down on you, pouring down on you, in the form of not global climate change, but a sort of a new financial crisis that will hit each single family, each single corporation and bank, and the gold will be in value again, of course, after that. You will not be able to... The problem with central banks today is that by the time the next financial crisis comes, just think about it. By the time the next financial crisis comes, there will be no instruments to use. What do central banks do in order to recover from financial crisis? Decrease interest rates and print more money. That was the recipe, the single recipe all across the 2 decades that passed for now. Lower interest rates and more money to print. But now, how are you going to lower interest rates when they're already zero? Where? Well, one of the choices is to go to the negative territory, just like they did in Japan or in Switzerland. But Japan and Switzerland are the smaller nations, so to speak. Well, Japan, of course, is a very large economy. Yeah, it's $5 trillion GDP. It's half China's GDP, or maybe a third of China's GDP by now. Well, this was before China became number 2 country in terms of GDP. That was, Japan was country number 2 in GDP as well. But still, I don't think that every country in the world will be able to do that. And we've seen, starting from August 2021, many central banks across emerging countries, and even some banks in the rich countries, like Norway, for instance. Norway, a Norwegian bank, increased its interest rate, and that was one of the first rich central banks to increase its interest rates after the global pandemics. They increased it up to 0.25%. This is not large, this is not much, but still it is a signal. It is a signal for something to be done. Russian central bank increased interest rates, its key interest rate, several times already. The same did Brazilian central bank and other banks across emerging nations. That means money is going to be valuable, paper money. And if you do not do this now, if you do not do this in expectation of a greater financial crisis to come, central banks will have no instruments to get away, to overcome the crisis if something really happens. Yeah? So, the United States and the United States Fed, the US Fed and European Central Bank, they exhausted their capacities. And they have absolutely now, they have exhausted it so much, they abused their power over the economy so much that one economist just compared the situation with a carriage which is driven by 8 horses and there is no brake. So it does not know how to stop it, how to stop these horses. They are mad in their spectacular drive, and there is no driver to stop it. And nobody is, they just do not know how to do that. Jerome Powell, maybe he is a good person, maybe he is an experienced financier, maybe experienced banker. Actually, he does not from the banking industry and financial industry. He, in the end, Ben Bernanke was more experienced in that way. I think that his problem is that he just does not know what to do, and other central bankers also. They are afraid of taking these steps. And this step is to actually increase rates now. Because when the crisis comes, there will be no more instruments to use. Yeah, that would be a very difficult question for them to decide. So maybe it's really a time to buy more gold now. Because gold, yeah, like we've seen here, so we people living in Russia, maybe we should buy it. Last time we said that 3 times already in a couple of, from March, it touched the same price. So it is probable that gold price will not go down more than 1670. That means at the time it touches again this price, it is a good idea to buy gold. Thank you very much.